Well, ladies and gentlemen, thank you very much to having invited the Commission, Commissioner Barnier, to this very important event of the German banking industry. First of all, I have to convey the best messages of my Commissioner. He apologizes that he couldn't be here. He was not hauled up by the snow as Minister Schäuble, but he was hauled up because he has to work on the sausage, which is better you don't see how it's made. Just to reflect how Madame Lagarde has said this about. There are the finalizing negotiation about the single supervisory mechanism, which again we have heard a lot about in the first part of this event. Now, before I go into the subject which I have received, I have to express my sincere thanks to Anshu Jain for praising Basel III. It's better he did it as if I have to do it, although I have to speak about the CRD4. And of course, I have to assure him that I have also listened to what he said about the other regulatory measures, which he is not so much supportive of. I will very carefully take it off and share it with my colleagues in Brussels. And let's hope that the dialogue you referred to in Berlin, whether in Brussels, this will bring solution to the outstanding issues. It's never easy to find a regulation which makes everyone happy. Now, anyway, it's a good news that although Mr. Barnier cannot be with you, that today we made a big progress toward the single supervisory mechanism. I don't want to repeat all the arguments which had been already mentioned, why it's good, but let's hope that at least for the 6,000 banks of the 17 and soonly 18 Eurozone countries, and for all other countries who are ready to join the single supervisory mechanism, it will be a much better regulatory framework. And this is a good news for financial stability, as also for public finance. Once a new single supervisor is in place, the European stability mechanism will be able to become what has been often said, a real backstop. But it can only start to be a backstop once there is a single supervisory mechanism, which, and this is even more important, is more wide-sighted, more credible, and less impartial as a fragmented supervisory mechanism we have currently in Europe. And that's very important to bring Europe back to the path of the growth. In addition to the single supervisory mechanism, the European Commission will propose during the summer 2013, but in this year, that very clearly, a single resolution mechanism to establishing a genuine European banking union. We have heard about how important it is that not only to have a single supervisory mechanism, but that has to be completed with a single resolution mechanism and a common platform of protection system like deposit guarantee schemes and lender of last resort. That last one is really a task of the European Central Bank, and all these regulatory proposals will come out soon. But let me turn now to the main topic of today. It's the single rule book, which is at the heart of the banking regulation. It covers rules which are strengthening, such as also the protection of the deposits, stress tests, and tools to resolve banking crises to avoid taxpayers' problems. But last but not least, the single rule book will include new capital requirements. Not simply more capital, more importantly, much better, higher quality capital, which is very important to go ahead, and that is really at the heart of the agreement of the G20, whether it's in 2009 in London or later were in Toronto, as frequently today it has been cited. Of course, it took us quite a long time until we could come so far, because it was quite easy to agree in London and in Toronto about the directions which to go, but it was much more difficult to establish the right rules and to fine-tune them in a form that it can work. And that has taken so much time. There is very frequently a criticism coming up why it took so much time to get the new rules in place, although there was a broad agreement what the new capital requirement should stand off, but it is very clearly that we have got a global financial market with very different national and regional banks, so it has to be a rule, a set of rules, which is not one size fits all, but which fits all these differences. It has to be something which Mr. Jain rightly said is not allowing any arbitrage, because otherwise that would hurt also proper allocation. It has to be something which provides time for transition, because not everyone can meet immediately all the new requirements as high they are. And of course, it had to reflect all the lessons we had from the financial crisis, namely that it is not affordable to have a too huge leverage ratio. It's a long lesson from all financial crises we had ever before, that there are two major problems which lead to any credit crisis or any. One is if you have too high leverage ratio and if there is too much maturity transformation. And both of these things had been done. So both these things had to be addressed. On one hand, the leverage ratio is partly handled with the new capital requirements, but also a leverage ratio had been introduced to make sure that, despite of the risk weighting, which is another highly disputed issue, and you remember the words of previous speakers that this has to be yet addressed, stops. And on the other hand, the high maturity transformation which had been met is addressed by the different liquidity measures and requirements. And these are the reasons very clearly why it had to be. Again, it was very difficult to reach an agreement on this, although everyone praises, yes, we need more capital, yes, we'll need a liquidity requirement, but to find the right calibration was a very difficult exercise. Again, the different banking models will have different indicators, and also we had to recognize in Europe that in some countries the financial system is different. So you have to be able also to let work the rules in Denmark, where there is no much government debt, so there is not enough local government securities, and you have to make also sure that it works also there, the new rules, and in an equal way. Also very important part is that not only you need new rules, but we have very clearly heard also in the morning session that we need a better performing supervision. And of course, although it's not part of the CRD4, but very much how the new rules will work is very important, that we have good supervisions, able to watch to it, and having continuously feedback. Because again, returning shortly to the criticism, we have frequently heard about the new liquidity rules. One is that it said it is too rigid perhaps, and it's not reflecting. But I wish to remind, very clearly it was recognized. There is a transition time now given by Basel Committee. Moreover, there is a continuous focusing on and monitoring of the development, because a very important part of the new rules has to be, it's not like the 10 recommendations which is put just on the stone and then it's not hold. On one hand, supervisions have to insist to implement all the rules which are carved on the stones, but on the other hand, being enough reflective to see and follow how the world is developing and whether any adjustment is needed. Basel Committee has already shown that it is able and willing. For example, in the case of trade financing, there was a revision of the particular rules, and there was a reflection on it. And the same has happened with liquidity. So I can assure you that there will be from the global regulators an openness to follow up the development, and this can also perhaps provide you some certainty that the new rules, as heavy, as complicated they may seem, they are not taken as such which must prevail without continuous checking back and speed back. Now, let me look not only how the new regulation will impact the banks, because we had heard also already from Anshu Jain about the impacts, and once again, thanks for the appreciation he spoke for Basel III. But let's look also what impact the new regulation will have on the customers, because at least that is as important, if not more important, than anything else. And especially let me focus on what is the impacts on the SMEs, which are going to deliver a huge share of innovation in Europe, and which provide 85% of new job creation in Europe, which we need so much in Europe. Yes, we have heard also from Anshu, and thank you that he took up the examples that, of course, in Germany you have different models at the SMEs as in elsewhere. Other countries, or in other countries, the small and medium-sized companies are more open to capital markets like in Germany. So it's again very difficult to find a common solution. Nonetheless, it is an aim of the new rules that it is an ability, and banks are having an opportunity to help the SMEs to alive and to finance them. And not only you should consider which risk weight is attributed to the SMEs, you should also please think that there are other measures taken also, that there is no credit tightening to the SMEs. What I'm thinking on, just we have agreed with the Parliament on a new Europe-wide fund for venture capitals. We have proposed new legislation on securities markets which enable an easier access of capital markets, and although this may lead to that some part of the business of the banks goes over to the capital markets, but we have heard also figures that Europe is very much tied on the banks, and if the banks are going to deliver, and that is what's going on, and then the companies are relying more on the capital market, that can help also to fulfill this deleverage. And I think that it's the house bank which has to provide help to the SME to tap rightly the capital market. So I don't see necessarily a controversy here on the new rules to go forward and to help the SMEs and the new rules. You have to look with the holistic approach to the. Lastly, let us not exaggerate the amount of capital the banks have to raise to comply with the new rules. Very frequently they said that there are too high requirements. But since the Commission has adopted the CRD4 proposals, the banks in Europe have embarked on efforts to raise some 460 billion euro in additional CET1 capital in order to meet the Basel III requirement, which is prescribed for 2019 at 7%. So I have to say that at least the largest banks already now meet these higher capital requirements, and we are yet far from 2019, which is the original target. So I don't think that the requirements itself, at least from capital side, are hindering and hampering the progress. But of course, I do not want to hide that CRD4 and other regulations will require a measured adaptation from financial institutions. But at the same time, let us not forget that the proposals have been carefully fine-tuned and accompanied with other measures which are aimed at to make sure that there will be no substantial negative side effects on the economy. I'm not only thinking that any proposal prepared by the European Commission must be accompanied with an impact assessment. And similarly, also the Basel Committee came forward with impact assessment. So it was upfront very clear that, of course, the higher safety will have a cost, but if we look to the cost and compare to the expected benefits, there is a clear summarized benefit. Nonetheless, of course, we have to look always to the possible backside. And also, by the way, let us recognize that Basel III is already implemented by a dozen jurisdictions. We heard this morning Japan, but I may also add that Canada, India, just to mention, South Africa, and Switzerland have already adopted Basel III rules, whereas Europe and the US, the two major financial markets are not yet there. Of course, that means, and this is sure, we have to make it very clear that we need a global level playing field, not only for the competing banks that they are having the same requirements on the globe, on the global financial market, but also that there is no regulatory arbitrage. And so all the efforts that we have done by improving the financial regulation can be circumvented from left around or from right around. So once again, it's not only about to protect the interest of our banks here, elsewhere, but also about not to have a situation where from outside it's possible to have an impact and having an arbitrage. And that is very important for the financial stability. We, of course, have to reflect also on how to reinforce global governance in the field of financial services and the regulation in the bank. And this framework is now the G20 and the Financial Stability Board. The European Union itself will hold its promise and will apply Basel III, not as originally planned from January this year, because that's already not possible, but will from January 2014 on. And I think that the political agreement with the Parliament is already progressed as far that this can be the case. And of course, also we hold the original deadline. So later introduction doesn't mean that the whole process and requirements are postponed. It means just that we start to apply one-to-one the new rules. However, doing so, we are also looking very much to our major partner, in particular the US, that they should do the same. When Commissioner Barnier has visited the United States, wherever he had been, he raised this issue and also recalled that we had already in the past certain problems, that there was not a synchronous implementation of the former Basel rules, a mistake which we cannot again let to be repeated. We got very serious promises from side of the US, and itself the Financial Stability Board and the IMF is also reviewing that the US, after reviewing the certain problems, they are connected allegedly with the community banks, because mainly that is where from the complaints have come, that they will introduce, and then we will really have in place what we have dreamt for, and then we have a global level playing field. But this is not limited to Basel III. Coordinated implementation should be pursued also for other G20 pledges, such as the regulation of the derivatives, and there we see a little bit also that implementation and rules and proposals are diverging. Nonetheless, there are strong efforts, also with the help of the IOSCO, to have here similar regulation, and I fully appreciate those who are saying it's important to look to Basel, but we should not let from the eyes other issues which are necessary, that also the derivative trades. And of course, Christine Lagarde has also mentioned, if you are with the derivatives, that also accounting is important, at least as regard of the derivatives, because itself there in the US and in Europe there are different practices to put into the balance sheet. And of course, if you don't correct it, you can easily come to different conclusions regarding the figures, because in the US you have a netting of the derivatives trade, whereas in Europe we are on the gross base. I don't want to work more because I've taken already much of your time. Now, of course, the most important issue is, I said, to align our efforts with the US, and we do see a very good opportunity to go along also on the base that the US and Europe do want to have a free trade agreement, which had been announced and is supported both by President Obama, and on the European side, it's put on the agenda by my President Barroso, but also the G8 leader, the British government, has given a big weight to it. And in this frame, we can perhaps agree that in rules and in the level playing fields, we are assuring a better and closer cooperation between the two big markets. And we have to do that because we had been warned that with the time, the importance, the weight of other markets will go to increase. If we are not stepping up now, if we are not doing now the right steps, we are going to lose the influence and also of the attraction of an agreement which maybe now we can reach on both sides. Ladies and gentlemen, let me assure you on behalf of Commissioner Barnier that the European Commission will continue to make all its efforts to meet all the preconditions which I have mentioned already. We will make sure that the new capital requirements are carefully fine-tuned to serve and not to penalize the real economy, and that these new rules are matched with similar requirements in other major jurisdictions like in the United States. This is how we would like to make the financial environment more stable, and I hope that really there will be a much better, more stable framework created by the new rules for the financial operations, and that will enable that Europe and other parts of the world will be able to sail safely for a long time without any major further crisis. Thank you very much for your attention.